measured move? Um, it's a good topic, really. You can use it on any time frame. You can measure anything, but there's some industry standards that are worth talking about first before we get into other details like special circumstance measured move and unique concept measured move. So in the textbooks, anything can be a measured move. Some classic ones are the head and shoulders. Generally speaking, one of the shoulders is going to be less than the other most of the time. So they won't be a perfect head and shoulders or equal shoulders. And a lot of times the lower edge on those necklines, one side's going to be lower than the other. So what you end up with is this sort of angled. Let's see if I can do it differently. Yeah, there we go. So you'll end up with this sort of angled trend line. So when that happens, what we want to do is measure from the top of the head to wherever price breaks. Now, I like to use this spot here, but I believe in the textbooks they tell you to use that spot right there where price breaks down from this trend line. The reason I like this one instead is because you're actually breaking it for like a breakdown of a vertical and horizontal level rather than an angled level, right? So then that can give you like a 786 up here and a 111 and a 1236 down here. But that angled break is what we do for head and shoulders. Now, rather than drawing all of these out, when I was getting into studying price action and candles, and we kind of talked about this in the last stream, there has to be a better way, right? Rather than reading all of these old, boring candle books that talk about bodies and wicks, right? Which don't get me wrong, you should read at least one price action book. But what about the patterns? And there's so many patterns. What I found to be easier is to go to Google and search for what you want. And then up at the top, it'll ask, hey, what are you looking for? Are you trying to buy it? Do you want videos? What do you want? I want images. And if you do that and you type in what you're looking for, you'll get all these images, very often giving you exact shape and patterns for what you're looking for. And that way, one, as a quick reference, you can always just Google a pattern and look to see how you should measure it and then how you plot the breakdown. But two, if it's something you never heard of before, then you can do it that way too. Patterns come in all shapes and sizes, even a head and shoulders and an inverse head and shoulders. They can be really ugly things. Things that when you're looking at it at the time, you may be thinking that sure don't look like any head and shoulders to me. It doesn't matter uh, as long as it's classified as the head and shoulders. Like this one up here, that's not a really clear one, and certainly this one's not a clear one. There's a lot of charting software out there that will find head and shoulders for you, or other patterns. I don't want to necessarily say head and shoulders, but the thing about those is they'll even bring you things that are trash, weird, junk, and like that doesn't look like what I'm trying to find, and yet that might be what you end up with, right? So you got to get used to that. Sorry, I'm trying to adjust something on YouTube. Just a second. All right. No, I guess it's not all right. Okay. It's going. It's going. It's fine. It's not broken. So every pattern has a spot where you're supposed to measure its length, rising wedges, falling wedges, ranges. So if I type in wedge candle pattern, you can see that we've got rising ones, falling ones, and it'll talk about where to measure it, how to project it. What the textbooks don't tell you is there's little subtle nuances to different patterns. And Bowowski has a candle book encyclopedia. I think he's the premier eminent candle pattern guy out there. Yeah, this guy, Encyclopedia of Candlestick Charts, Thomas Bowowski. Now, the reason I liked his stuff is because he put percentages behind how often a particular pattern would follow through. Because it sounds good, right? If someone can give you statistics on how often a pattern works. The problem is his book is focused on day trades, first of all, and on and it's really old data, second of all. So not so great, right? When you put it in that perspective. Haha, I lost connection to my other computer. All right, so that pretty much covers the idea of measured move. Because if anything can be measured, if you ever get into any textbooks on candle patterns and it talks about ranges, one thing I can't stress enough, a range is anything you want it to be. So one candle can equal a range. And I get it if you're kind of new to this and you think, how is one candle a range? Well, one single weekly candle, for an example, between this week's high and this week's low, if I open that up on a daily, well, now this week's high and this week's low has two candles. Okay, that's not too bad. What about on an hourly? Now we've got a lot more candles. All right, we'll just go in and we'll set this. Today's the 25th, so we'll set it to uh, the 23rd. So that'll back it up to there. We'll just delete this and duplicate that one. Ha, you like it. So now look how many candles we have. All from that one weekly bar. Now we've got all these candles. It's starting to look like a range. Now we've got this many candles. It's certainly looking like a range, right? So one bar can be a range. It doesn't matter if it's a 1 minute bar, it can still be a range because there can be 5 second candles inside of it, right? So when the textbooks talk about having a range and measuring a range and then projecting away from that range with a measured move, the textbooks will talk about 50%. So measuring this distance and expanding in one direction by 50%, and then going the same direction 100%. Every single textbook out there has covered that concept. And while I didn't mark it, if you ever do have a range, you should mark the midpoint of that range. That's usually how I designate midpoint when I'm doing my journal work. If I didn't have it marked on the chart and I traded the mid in my journal, I mark mid like that. We all got our own little chicken scratches. So that's where the idea of measured move comes from. I I know somebody always asks, why does it work? And I wish I knew. I really wish I knew. But there's a lot to trading that we just don't have answers to. At least I don't have any answers. I don't know why it works. As long that's exactly right. As long as it does work, you know? But it does leave you wondering sometimes, like theoretically speaking, why in the hell does that even work? I don't know. I don't know, but it does. Try not to get too hung up on the textbook, really fancy patterns that are out there, the rising wedge, falling wedge, head and shoulders. I get it. They're easy clickbait to kind of get gravitate to, but especially for intraday trading, they're just not very viable, right? And don't get me wrong, even today we had a rising wedge on the intraday on the ES today. I spotted it and was like, "Oh wow, look at that rising wedge." And then it blew off top, and I was like, "That's perfect. Blow off top on a rising wedge. We're going to flip and dump." Well, there's the dump. I mean, it took a little bit, but there it goes. So, um, we can use these patterns for analysis with way better results than using them to trade. And I think that's where a lot of traders get it wrong. They think they can trade the head and shoulders, they can trade the rising wedge, and you probably could. Maybe your risk is different than mine, but I never really have much luck trying to trade the pattern itself. I'd rather use the pattern to define my analysis and say I should be looking for longs or I should be looking for shorts, and then find a long or a short opportunity to trade because the pattern told me I should be looking for longs or shorts. So if you don't know the million and one different patterns that are out there, I wouldn't stress on it. They are a work in progress. Just slowly pick them up throughout your life as a trader, and there's no rush. The more that you recognize, the better off you are for sure. But it's not a make or break situation. It's just going to help you better see what's going on in price, right? Because I saw that rising wedge and I had the idea that it was going to break down, but I mean, I didn't know when. Somebody else could have looked at this and said, "Yeah, it's rejecting off of whatever level. I think it's going to break down." And so they'd have had a short. I would have had a short. Doesn't matter how we got there. Just mattered that we recognized that it was supposed to fall. I do know a couple of traders who kept the old 1618 on their projections. I don't do this, but they are swing traders when they do this, right? Um, I don't even think that they intraday, but I have seen it. So when it comes to what you should project to, the textbook says, 1.5, 2.0. I use 111 and 1236, but I know traders that use 1.618 as a swing trade projection level. And then, of course, the textbook's 2.0. Those are valid targets. 1618, 2618. It's just whatever style you use, right? And like we've talked about before, you can use whatever number you want on that Fibonacci as long as you can prove it works. Swing trade has larger targets. You know what I mean? I don't know any other way to say it. They have broader time horizons. So 1618, I guess, works for them. Plus equities, equities just do weird stuff like blow out and run like a mad demon for 6 weeks nonstop every day green. Equities move way different than indexes. which are mean reverting. So measured move. Hopefully that covers the questions from the person, you know who you are, that asked. If not, you can always, hit me up with more follow-up questions and we'll dig deeper. That there's no end to how deep it can go. It just so that covers the textbook. Now, me personally, I like my 111 and 1236. I like it. It works. I'm comfortable with it. And when it doesn't work, it's usually a heads up that something is wrong, right? Like we got this OCC here earlier. It was perfect. So I moved up like we do, you know, and on that next run, it just blew right through me and kept right on going. And when that happened today, I didn't look at that and say, oh, dang it, I must have drawn it wrong. I screwed this whole thing up. No, I didn't do anything wrong. I did it exactly the way I'm supposed to do it. Price was telling me that this was some kind of blow off top mean reversion setting up and that we were getting way too far ahead of our skis. So that's good to know. Like it's validation of my own analysis. So when this happened, I just had to wait until we finally did get the OCC and then move the drawing up at that point. But you can see how stretched the drawing is. I don't like it when it gets too stretched out because then the distance between each level is too wide. So what I do at that point is I look for ways to tighten it up. And so pretty much this afternoon I've been using that range right there. And it's not perfect. I mean, I could use that wick there or, this body here, but I had it snapped. I'm pretty sure that's where I had it snapped earlier. My tick chart looks different than this. That's why I'm not 100% sure if that's where I was at, but it was one of those and it wouldn't matter. It's not going to break the bank on one side or the other because it gives us our 786 and the 111 lined up really well. It's good enough. So you can always just tighten your range up if it gets too big. And so far, that new range is holding really well. We've tagged 111 twice and failed to get through it. Had this beautiful drop into 786. If that fails, we're going to half. And if half don't work, then we're going back to the RTH open, which is this low down here. So if it gets too big, it's how much money you have at risk. For everybody, it depends on how long you're going to stay in the trade. Are you actually going to stay in until we get to the next level? Are you just going to hop in and ride it until it's moving in the right direction? Where do you put your stop? So, also on the analysis side, if you are waiting for the next level to breach before you can consider the next level open, if the levels are too far apart, you might wait hours before you have validation of the next level. It's not necessarily a good thing, a bad thing, right thing, or a wrong thing, but you can see how these levels are a lot farther away, right? Look at this 786 versus that one. It's another 10 points lower at least, right? Or 9 points. So, sure, 6750, which is this lower 786, is a much more valid test because if we break 6750, it's game on to the downside. And it's also 786, which lines up with game on to the downside. But look what price is doing because price is fractal. It's still hung up on that shorter 786. If the short is good, we'll make it through this smaller 786 and we'll get to this larger 786. But at least we could anticipate some resistance to that downside move with having that shorter one in play. It's not a perfect system though, because if we start making logic like that, then the next thing you know, we're measuring these tiny little ranges and using those little 1, 2, 3, 6s. And I can tell you now, you're going to feel a lot of pain if you try that. Unless you measure that and then go down into like a Jeremy style 10-second chart. That would probably work. So I don't like them when they get too stretched out. Um, it messes with my trigger for the next level, validation of my analysis, my next trade, all of those. I wouldn't even have been trading this afternoon, but I'm trying to get comfortable on that other account. And if I don't do it in the afternoon, then it's never going to get done. So, well, let's get some one lot, two lot trades in this, and the opportunity was there. So take what we can get. So since anything can be a range, and since anything can have a measured move, when we get something that stands out, it doesn't even have to be really awesome stuff that stands out, right? Like this candle here, that's not crazy wow, right? But mark the mid of that, and it's what we're hanging up on. Why that candle? Well, it's the breakdown candle. When we stalled here, they were trying to hold it up, trying again, trying again. We finally broke down. So there's that. Then there's the size of the candle alone. And we closed underneath the mid. And we can see that we're challenging the mid on the other side. Anything can be a measured move, anything can be a range. So we can take that one candle, we can measure it out, and we can project levels higher or lower. We can mark its mid, we can find value out of that, especially depending on what time frame you trade. Oh, I'm good. How you doing? No, thank you. That's good to hear. I don't hear much feedback on those morning briefings, to be honest. It's like I'm just shouting into the wind. Yeah, it's definitely going to be tricky. Short weeks are always that way too. Yeah, I remember having this grand plan back in the day of trying to get all of my stuff done in that 8 to 10 window or 9 to 11 window. And I eventually grew out of that. I really like my pre market. And then after lunch, if I get anything in the afternoon, then that's good too. I don't even bother with that 8 to 10 or 9 to 11 window. The tricky part, I think, is when we look back, the candles are already done, they're already formed, and we don't see how violent it was while that candle was alive. And so we look back and say, I could totally trade the open. That looks really easy. Those candles are fine, because we didn't see how violent it was when it was forming and those big moves and how you need such a big stop to be able to trade it, or you got to be on such a small time frame to see those gyrations and try to avoid them. Yeah, and when it comes to the Nasdaq, a lot of times I don't even look at it intraday unless I'm doing analysis and I just need to know what the Nasdaq's doing. I don't look for trades on the Nasdaq most days if the market is open. I look for Nasdaq in the pre-market. That really suits me well. And then once we're live into the 9:30, I go to the ES. There are days though, like if the ES is really nasty, I start shopping around to see if I can find something better. And sometimes it is the Nasdaq, but by default, I start with the ES and then kind of move from there. Have you come up with any self adjustments yet? Started tweaking it to your own style? That is interesting. Yeah, I might have to play around with that myself. I kicked 618 to the curb a long time ago, but um, it never hurts to circle back with new information. For you guys that are day trading options, um, you might be better off if you're trying to do intraday trades and you're not doing this yet. Think about joining the sell side. I know it requires margin, and a lot of day traders are using cash accounts so that they don't have any PDT to deal with. But hopefully soon we're going to be seeing changes to the laws of the PDT and knock it down to 2,000 instead of 25,000. But if you're on the sell side, instead of asking where are we going and how far do we think price can go, you can take the other side of that trade, which is a lot easier in my opinion. right? I don't mind easy at all. I'll take easy anytime I can find it. Easier to me is this concept of where should we not go? And if you can answer that question, you can trade it in options as long as you can run a spread. So take SPY for today. Do you really think we're going to get above 675? Or if you want to tighten that up, 674, maybe even 673 and a half at this point? And if your answer is, well, when do I think we're going to get above there this week? Maybe today. Hell no. Sell that call. You're paid. Now I get it. Like, well, how much money am I going to make selling a call on the SPY? I don't know, maybe $1,000, maybe. If it was the SPX, 25,000 today by market close, no problem, easy. You see what I mean? Like, did I get your attention? Yep, I'll see you in the morning. So even though it's sell to open trade, you can make some decent money doing that trade, right? We're talking 0 day, things that'll expire today at the money. Let's just tighten these up. We don't need 150 of them. This is SPY. So price is at basically 673. We could split the difference, 670, 675. We're looking at $3. So that's not going to get our $1,000 that way. The problem is it's so late in the day, we don't have anything out here. These out of the money calls, there's none out here. So if I go any wider, we're just going to be basically leaning against the short leg in the money and not the long leg out there to take the other side. It's fine, I guess. Just do 10 of those. Right? If you do 10 of those, then you're looking at $3,000. There's never any guarantee of any kind whatsoever in trading, ever. If you break the 786, your conviction is that you're more likely to go to half than to go back up to 100. But all of these lines and levels are worthless without the ability to have a bias behind it. Like, what's my bias right now? That we failed our run and we're going to roll over, and that this was a rising wedge blowout with a blow off top and we're falling. The drawing be damned, the 786, the 111, none of that means jack if I didn't already know that we topped out after a blow off top and we're falling back down again. So you can snap lines and levels and drawings and halves and mids and everything, but without any bias behind it, you're a coin toss. And you'll always be a coin toss. You'll have no bias whatsoever behind it. That bias comes from tick, trend, UVol, devol, news, market updates, what the VIX doing, 10-year yields, right? Like what's moving price kind of stuff. Lines and levels, worthless without bias. Sucks, right? Well, once it reaches your measured move target, that you're done. It reached the target. The the sell side trade that I was talking about to make $1,000 would be to sell calls up here, collect $3 and whatever cents per spread, and let it decay, and then buy it back cheaper. Yep. It's not a directional trade. That's the whole point that I was trying to make. That if you're struggling to make a winning trade and you're getting your butt handed to you because you're trying to figure out where price is going to go and how long it's going to take to get there and how far it could make a move, try the other side of the trade. The other side of the trade is the sell side of the trade that says, I bet price won't go higher than ABCD, right? Whatever number. And all it has to do is stay under that level and you get paid. How much do you get paid? Well, how much did you sell it for? Because that's how much money you'll make. This was three something a few minutes ago. It's already made $60. If we had 10 of them, it would have been $600. Now, I like to use the SPX rather than the SPY so that I don't need 10 of them. But either way, right? These sell side products, however much money you sell it for, that's how much money you can make at the end of the day. And I don't hold them until the end of the day. Personally, I don't want to hold them all the way to the close. But this is $1,600 right there. And I only have one of them. I don't have 10 of them. So I could sell that and make 1,000 all by itself. Just close it early, leave 600 on the table, and just take my 1,000 and go home for the day. I like this one. It's only 25 points wide. Make it 100 points wide to where you're collecting $42 in credit. That's $4,200. Widen it out, right? So, the what's the bias? I don't need price to run. It doesn't have to go anywhere. It doesn't have to reach some certain destination. I don't need too much travel. All it has to do is stay below my break even, whatever that break even happens to be. If I choose 68, 67, 60, then my only ask is that it stays below 67.60. If it does, I make my whatever amount of money. Right. The prevailing go to, though, by most zero-day traders that are selling trades is that you manually close the trade on your own and you don't let it go into the close. But there's no rule that says you have to. You could certainly let it go into the close without touching it whatsoever. And depending on your broker, it won't even count as a day trade if you do that. Tasty, for an example, Tasty Trade won't count that as a day trade if I don't manually close it, if I leave it open and let it expire on its own. Now, the SPX is very big and it's very scary. So, if that's too big and too scary, there's the XSP. It's exactly like the SPX, except it's priced like the SPY. If you look, it's not penny to penny perfect, but that's SPY prices 674. Now, it's not as liquid as SPY, and it doesn't have as many expirations, I believe. Oh, yeah, it does. Yeah, that's cool. It has the same amount of expirations too. It's a smaller, cheaper version. You can't be assigned, so you never have to worry about, somebody assigning stock to you. It's cash secured. Um, there is no stock, so that's awesome. And if you don't close the trade, it won't count as a zero-day trade. But I don't encourage people to hold on to them into the close. There's a reason that the industry standard is to close them early. Get 40% profit or 60% profit, shut them down and move on to the next trade. Me personally, when it comes to these sell side trades, I have two. One that I do in the morning and then one that I do in the afternoon. And I got to say, I haven't done a morning side trade like this in a long time. I just don't trade that morning session very much anymore. I'd much rather do the afternoon session. And by afternoon, I mean later than noon Eastern. If I open a trade anywhere around the 11 o'clock time frame, 11:30, I've lost that trade more than any other day trade that I've ever tried to run in options if it was opened between 11 and 12. Now, maybe it's just my bad odds, right? Maybe I just suck. But You lose that trade so often, you just get to the point where like, yeah, no, I'm not doing it, and I won't do it. If it's not past noon, I'm not running a 0 day in the afternoon. Something to think about, which I've thought a lot about it. I haven't done this yet. Maybe we can game out at some point how to do this. Putting on tomorrow's 0 day today. It always makes me think of that old TV show where they got tomorrow's newspaper today. I don't remember what it was called, but it was a janky cat video show. You guys remember that? Or am I just too old? Anyways, putting tomorrow's 0 day on today also helps you eliminate PDT, right? Because you put it on today, you close it tomorrow. There is no PDT. But then we have to try to figure out what level are we going to try to trade against. And well, that can be a lot more tricky. These 0 day trades, there's a lot of people out there that will run them every single day of the week and they do not care. Me, not so much. I like to have a reason to think we're not going back. So I was going to use Thursday for an example, but it didn't fit because we just kept going and going and going and going. Thursday is unusual. We don't usually do that, right? Normally we go really hard in one direction and then we flip around and we go back the other direction. So I look for those days where we've had big runs in one direction and then we change direction around lunchtime. I like those for 0 day plays. Some of these, for an example, this one, not as good, but it worked. Or this one, those are really good reversals after lunch. This one, too, after lunch. This one, actually, we just finally broke out and ran after lunch. It's kind of the idea, right? So, with my style being quote after lunch, putting one on today for tomorrow's expiration gets a little tricky. But if we can keep the risk low, then and we got the right odds, it won't matter. That's the sweet spot in options. Low risk, high odds. And today does count for one of those times where we ran in one direction and we turned around. But we've been holding above this ADR line and it's been failing to drop. So I don't like it I wouldn't even have liked it back here when we ran up on that rising wedge breakout. Because that rising wedge breakout, before we recognize that as a pattern, we have to recognize how violent the run was. And it looked like it was forced buying, news driven, algo, just like an algo punch. You don't want to get in front of those, you know. Now, when we attach it to the rising wedge, then we're like, okay, cool, it's probably going to reverse. But do you really want to risk, $900 on a reversal that is maybe tied to that rising wedge blow off? I don't know if I would have. These trades that we're talking about, the size of the trade is your risk, right? So let's just stay on the SPX for a minute. These are $5 wide. So the smallest one that you can make is $5 wide. Now, the whole thing is $5. If I get $3 here, then I'm risking two. I'm risking two to make three. Hey, that's not bad at all. But why are they offering me $3 at the money when it's not worth more than 2.5? They really want me to sell this trade. They're offering me a lot of juice, like begging me, please sell this trade. You should totally sell this trade. Doesn't that make you nervous? When the market agrees with you and they're like, yeah, yeah, man, do it. Do it. Here, we'll give you extra money if you do it. Look, they're offering 325 now. Exactly. But they really want you to do it, right? This is a call credit spread. It'll make money if the market stays underneath that level. But as long as you're split the mid then this trade should be half the width, and it's not. So let's go a little wider, 45 and 55. That way we're keeping it split the mid because we're at 50, 67.50 perfectly. This trade, $10 wide, should not be worth more than $5. And they're offering us 35, 45 cents. Still, what's the risk? Whatever you don't see. So if it's 10 wide and I've got 580, then my risk is 420. That's how much max loss you could take. But nobody says you have to take max loss. And what makes my approach different than the wannabe guru YouTubers out there, when they talk about this trade, they'll say, oh, price shouldn't get above, say, the high of the day if we're right. That the high is in, we're not going to go back to the high, certainly aren't going to go higher than the high. And if you agree with that, then you build your trade. But what they'll tell you is, yeah, go way out of the money and put your trade way up here. Try to find something in the 10 delta or the 12 delta and sell that because that has a 95% chance of winning and you're going to win all the time. Well, they're not necessarily lying. They're just not telling you all the truth. Sure, you'll win 90 to 95% of the time, but you're winning pennies. And of course, the argument, well, I mean, I'll take $15 wins all day long. If I can win 1,000 trades at $15 a trade, hey, it adds up, right? The logic sounds good, except there is always going to be a loser. And these losers, if you build them way out of the money like this, there's no closing it early and avoiding a big loss. It's impossible. It cannot happen. They will be big, violent, ugly losses. And so you'll wipe out 50 winners with one loser. So those very far out of the money sold to open trades at 10 and 12 delta are trash. I don't do them. Do them near the money, at the money, slightly out of the money, just slightly out of the money. Do those. And that way, if you're wrong, you get a small hand slap. You move on to another trade. You got a lot of profit when you're right, a little bit of loss when you're wrong, and it's a manageable trade that you got full control of. Those ones that are out of the money really far, you have no control over those losers. But these levels, that's a good discussion that we should dig deeper into because there's multiple people right now that I know are struggling with this very idea. That they draw the lines, they got the right levels. Yesterday's high, low, close, Globex high, low, got all the levels, got the drawings, and then that's all they have. So when price gets there, now what? And unfortunately, the answer to now what isn't supposed to come from the lines and the levels. Um, when you were talking about your measured move being down here, I think it was right in here, 60s. Yeah. What did you measure? Somewhere right in here. Yeah, my bottom isn't in the right spot yet. I'm still trying to find where that 56. I don't have 39 on it. ES. It would be 50 or 25. All right. That is a very narrow range that you drew. The thing about having a very narrow range like this as the fib levels or as the quadrant levels, it'll work, but this is market compression. So the expectation is that it's going to come out of this violently and it's going to blow right through your 111 and 1236. So if you do this, use halves and holes on the other side, like a 1.5 down here and a 2.0 down here, because the violence of this compression should equate to big moves on the breakout. Even if they fail and come back in again, they should still break out really violently. So while these ranges, like anything can be a range, right? That we spent the first part of the day talking about anything can be a range. And so this absolutely it can be a range, but there's consequences to a tight range, right? And the consequence is that it's going to come out of this range really violently, and that the 111 and 1236 will very likely be so small because it's a small range that price is going to punch right through them. So we can't use like a stop at that level. We can't try to get in at that level. And it's very likely going to just be violent. But we can see the 1.5. Look, it's exactly where it went, to the 1.5. I didn't know that answer in advance. I just knew that if I was going to measure a narrow range like this, I would put a half on here and a hole, because I would expect that from a narrow range, price breaks out violently. So there's the upside, 111, 1236. And it didn't even have enough room to make candles to get to those levels. It just wicked there and fell back in again. The expectation is if we're not going to just wick there and fall, we're going to punch right through that and go to the 50. Because if you think about the regular way that we draw the level, there's got to be enough room there that when price actually breaks out, it has room to form candles as it climbs up to 111 and 1236. These 111s and 1236 is so tight, we don't have any room for price to do anything more than just wick into it. And yeah, both of them went to the measured move. I mean, they both went to 50 anyways. All three of them went to 50. Yep, that reversal. Do the little fish drawing there. I like those reversals. And it broke through the midpoint of the breakdown bar. And then a little pause there and a really nice continuation afterwards. So everything's tradable, right? Everything is tradable And these patterns, they work just like we're looking at. And it's the same thing that we always talk about. I'm just pointing out that the 111 and the 1236 have to be adjusted here, right? Because if it was somebody running a really small, like an ES, a MES, micro contract, single $300 account, $500 account, they'd have got blown out of the water trying to run a 111 or a 1236 here, right? But looking for the reversal off of the measured move, it's not wrong at all, and it worked perfect. We just have to use a different measured move, like half or whole, 50 or 100, right? They do. It's one of the reasons I like them. Now, if someone was to ask me, but would I trade this? No, hell no, I wouldn't have traded that. It doesn't matter that it was the candle that I like. It doesn't even matter that it was a reversal right off of the ADR. I wouldn't have traded it. It was already, I didn't even like the trading that I did do back here. And I was done with it. I was done with it back here, or I didn't even want any more of it. I don't want this. I'll do it if I have to. I mean, we got to eat, you know. Oh, what you're doing is what we call drills, and it's perfect. It's what you should do. Otherwise, you'll never get any trust, right? So you're doing it exactly right. Measure different things, try something out. If it doesn't work, screw it. You know, at least you tried something and try something different, try something different. So there's nothing wrong with what you're doing. And it's the only way you're going to learn to trust it and trust yourself to use it. So it has to be done. But along the way, you'll find what works for you and what doesn't work for you too. It really does. And so do these TRB setups, because that's what that is, a TRB. Trend line breakover. I know it. You would think it'd be TLB, but when I was naming it and I was trying to come up, there was already something called a TLB, and so I didn't call it a TLB. But I can't remember what it was that was actually called a TLB. So I went TR instead. Trend range breakover, trend line breakover. I don't know, TRB. But that little sticker that I drew, that animated sticker, is kind of the same idea. Swing low, 3-bar reversal, TRB, Morningstar reversal, drop base rally. They're all the same trade. The reason I like these is the TRB has already squeezed the bears, and you get this bullish, very very large bullish reversal, and you're usually done in 2 or 3 bars. Sometimes in 1 bar. 1 bar will run all the way back to the top in a single shot. And I love that trade. When it comes to these, though, don't get too hung up on where you draw the line. I've had a lot of people ask, do I use the wicks? Do I don't use the wicks? Maybe the bodies, sometimes the bodies. I don't even physically draw the line. I just see the trend line there. And it doesn't matter if you have a line or don't have a line. It's price changing from these lower highs to lower lows and then flipping over and getting higher highs and higher lows. Preferably no higher low at all, right? If you look at that run back up, it never set a pullback, unless you want to count that little wick as a pullback. But these little micro ranges will get you in a lot of trouble if you try them too much, right? Every once in a while, especially if it's a really good setup, why not? You know what? Like, why not? But I rarely try that sort of tightness, especially if I'm going to run the mid on those. The mid on those are really dangerous. Maybe a first touch, maybe if I'm looking on a smaller time frame alongside it, or if it's a narrow range like that from a higher time frame, like a narrow range 15 minute or a narrow range 30. and then I look at it on my tick chart, like a 1500 or so. There was a lot of talk in the chat on this Thursday where we ran and ran and ran and ran and ran. Now, we can't spot that in advance, right? We never know it's going to do that. Believe me, I wish we could. But once you get like the third or fourth candle, if you even wait that long, and you start to realize, like, oh, geez, man, it's the same color and the same color and the same color. Drop to a smaller time frame if you're trying to focus on that, because it's the only way you're going to get in on those kind of days. But you'll never know it's quote those kind of days until you look back later. You have to be already in the mindset that we could be forming one of those right now. So have a number already ready that you can go to in case we get one of those kind of days. For the SPX, I like this 133. And I think I can still reach Thursday from here. Yeah, I can still reach it. You can see with the 133, there was a minimal amount of pullback, but at least there was something, right? Better than just nothing. But there will be. Well, if I'm looking for that pullback, right? If it's going to be one of those days where it just runs and runs and runs and it doesn't stop, you have to be prepared to go to a smaller time frame. The 1 minute works. The 1 minute at this point actually looks about like that 133 does, but they won't always, right? And my default, I like tick charts personally, but TradingView doesn't have tick charts unless you pony up a boatload of money for it, which is I get really salty about. So, 1 minute works. It's better than spending $200 just to get a tick chart. But my broker has tick charts, so I don't have to do that. I don't have to worry about it unless I'm going to TradingView. Yeah. I mean, I was talking to somebody about Thinkorswim the other day, and they're like, I can't believe you trade on that thing. I'm like, no, man, I don't trade on this thing. I just do all my work here. But I think 2026 is going to be the year, guys. I really do. I think TradingView is going to kick a lot of these companies to the curb because they're getting options data now. And that was the one thing holding them back that left people like me hanging on to Thinkorswim. If TradingView doesn't have options data, then I can't exclusively stay on TradingView. I always have to come back to Thinkorswim. But TradingView is connecting the options. And when they start getting a lot of coders who actually trade options, getting in there and developing really unique, sophisticated options indicators in an environment where we've never been able to do that before, if these guys had stock, I would totally buy their stock. I mean, nothing's wrong with it if you I don't know how to say it. Okay, I'm not completely picky. I'm just like a little picky, right? Their their P&L sucks. So you get some options trades on, say you got 75, 125 trades, right? And that's different positions, different names, different directions, up, down, sideways, whatever. Different things, commodities, stocks, options, futures. You're spread out, right? Then you want to go in and you want to look at your P&L and L and your position in Thinkorswim. It's a nightmare. It's an absolute nightmare. You go to the monitor tab, you got to screw around with all these different statements and working orders, old orders, canceled orders. You really can't adjust this much. And if you roll something, oh, forget about it. It's going to break your trade. You have no idea what your risk is. So then you're left going to the Analyze tab to individually look at every single one of your trades on the risk graph to see where your P&L is. I mean, it's doable, but it sucks. I can go to Tasty Trade, type in, just fire it up, and I can see my beta weighted portfolio. my risk to the upside against the SPX and the downside. I can break that out by commissions, trade lots, timestamps, everything all neat and clean and organized and really nice, sophisticated P&L. Most brokers have Thinkorswim's sorry P&L system. Most. Fidelity is not bad if you just want to look, but if you want to trade, don't choose Fidelity. They're not an active trader platform. So that's one piece. Then I've always been salty about this. They used to charge $5 per contract to trade options because, back in the day, all options were expensive. But all the people working here at the Bullish Bears were like, oh, well, we got a guy for that. Here, send this guy your email. Tell him that you want lower commissions because you're going to trade all the time and you can get it cheaper somewhere else. So I did. And he's like, oh, yeah, hey, we'll drop it down to $1 per contract. No problem. All you had to do was ask. We do it for anybody. Oh, wait. If you're going to do it for anybody who asks, and you don't have a problem with it, why are you just not charging me $1 a contract to begin with? And his answer was textbook. Why would we let you do it for $1 if you're willing to pay 5? I'm a big fan of putting things in simpler language. I think it, clears things up a little bit. So what you're telling me is you're going to kick me in the face over and over and over and over again until I tell you to stop or at least ask. But as soon as I ask, you're more than willing to stop kicking me in the face. All I have to do is ask. He didn't like that. But I didn't like being charged $5 a contract either. That's their mindset. Now, at the time, it was TD Ameritrade. It wasn't Schwab. But that was TD Ameritrade's answer is, well, why would we not charge you 5 if you're not going to complain about it? So now Schwab has it. And if you ask Schwab, hey, what's your day trade margin rates to trade futures? We don't have any. What? You mean I've got to pay full price to trade these futures? Yeah. So $26,000 per contract to trade the ES. You don't have a day trade margin rate? Nope. Come on, man. Do you not want my business? I can trade that same contract for $550 at Tradeovate. I don't need a $75,000 account to run 2 contracts. That's nuts. They don't want your business. So I don't want to trade there. They do have good charting though. I just think the TradingView is going to get it next year. It's going to be the platform that every options trader out there uses. This thing is going to be so pimped out. And you can already start to see options indicators starting to show up. If you guys don't go over here very often, when you go to the indicators, notice what I did, right? I just come up here to indicators. Let me get off of that chart and go somewhere else. IWM has been frisky. We'll look at IWM. So go to indicators and just stop right there. Look on the left side, go down. These, not the store, forget that. Don't buy indicators. But these other 3, editors, picks, top, and trending. If it's hot and everybody's talking about it and it's the newest thing, it's going to be in those 3. And you can find some really cool indicators in there. I'm not talking about indicators to make trades with, right? Because I don't trade with indicators. But to better understand what price is doing, to maybe have another level to be concerned about that doesn't line up with one of mine, or hell, validates one of mine, gives me more confidence about one of my own levels, anything like that. Better price analysis, tape analysis, and options. Always check out what's trending, what's hot, and the editor's pick because they've got some really great stuff for swing trades too. Correlation analysis, grouping, thematics. Next year, these guys are going to blow up like crazy. pivot measurements. What that is? Oh, okay. A little Pac-Man up there. It looks like a Pac-Man or the ghost. That looks like zigzag though, doesn't it? So yeah, I don't go in here every day and look around, but usually at some point I'll be in a trade and I'm trying not to move the stop and I need something to occupy my time, idle hands and all that. And I'll go poke around at what the new indicators are. Did you guys see my post today about Treasury and it's kind of a big deal. And Marziti added to the discussion yesterday with me. So I was already on this. We were digging around looking at something else. And he sent me this link yesterday. I put some of it in the chat. There's an issue with Treasury and the overnight repo and it's basically the plumbing, right? How liquid is the repo team, the overnight funding, short-term interest rates, all that stuff. So let me bring up this PDF. Oh, good, I didn't delete it. $150 billion liquidity storm may be about to hit markets. This is from 2 days ago. I got it yesterday afternoon from him, but I was already looking in this direction anyways because of me and Grok were talking about it. Treasury settlements. So this week, we've got two big days coming. Tuesday, which was today, and Friday, we've got 52 billion. So we've got to deal with these settlement dates. All right. So then I was talking to Grok about it. Where can I get the data? Blah, blah, blah. And then Marziti sent me that link, which is this PDF here. I'll put it in the chat for you guys. The S&P faces further downside treasury settlement drain from markets with 150 billion set to settle over the next 5 days. Now they got some numbers down here, right? And here's the outstanding versus the reverse repo facility. You can see the divergence here since like 2023. It broke away and it's been running, but it's getting into the extremes. And this side is getting almost to zero. That's the important part. It's drained. It's out 2 billion. The reverse repo facility has fallen to near zero and reserve balances have plunged under 3 trillion. So that's the balance sheet there in red and we're underneath that 3 trillion mark. Here's the fun part, the important part, right? If you're falling asleep from all the nerd out stuff. These last 7 days where we've had the reverse repos and the issues with the treasury settlements. The 30th, 4th, 6th, 13th, and then, to these to come. Well, these to come. All declines. There was no up days on the 13th, 17th, 18th, 20th. So on average, we've been running 1.18 to the negative. Now I'll zoom back in for these dates. It doesn't make it very pretty, but that one, that one, that one, these are all down days in the SPX. I know it's a very sorry picture, but he not necessarily, right? Like there is a couple of issues. We are talking government and 150 billion to the government is really a drop in the bucket, right? All things considered. So there is that argument. Then there's the argument of if they keep feeling the pain, because this is all really recent since like late October into November. It's happening, like right now. How many times do you stub your toe on that stool in the living room before you just chuck the stool out of the living room and quit stubbing your toe on it? So if this one situation is causing them pain, how many times are they going to suffer that before they say, screw this, and they do something to fix it? Either they reallocate funds, you know what I mean? Like adjust something so they quit feeling the pain. The reason I didn't really bring it up too much earlier is because it's just one data point, and I was worried that people would just see it as a flashing light to get out of the pool and everybody's going to bail out of their trades. I'm still in my trades. I mean, I've dialed back, sure, but I'm still long, net. It's a warning for sure, and it wouldn't hurt to shop around for some, lotto trades to the downside. But look at today. Today was one of those 2 days, Tuesday and Friday. Well, I mean, we ran up, right? So if it was that bad, where's the pain? I don't see it. We made it past 2 o'clock, and the market didn't just crash and burn. There was the I think the 2 o'clock was the 5 year anyways, wasn't it? Or like the 3 year. It was something really up front. So we made it through. We didn't crash and burn, but there is a liquidity issue, and it could get exacerbated. It could get worse. So I just wanted to point it out there, kind of give people something to read up on, focus a little bit on treasuries and overnight repo. And trust me when I say it's confusing stuff, right? It is absolutely confusing stuff. Chew on what you can chew on. It's a growth thing. You got your whole life to learn about it. No rush. And we've talked about that Bank of America liquidity chart before, right? When we talk about overnight repo, funding, and liquidity, I like to use that move index and the this one, the Bank of America options adjusted spread index. This is my liquidity gauge for overnight repo and funding markets and all that good stuff. So the main thing is just, there's still risk, and that's a thing. Yeah, right. I think it looks okay. It's the orange one is the S&P, and then the blue one is the spread index. Higher is bad, lower is good. And if you look at April when things were really bad, I mean that's what bad looks like. This is not bad at all right now, and it's pointing back down again. So it's worth checking out. I'm gonna put the PDF in the chat for you guys. You can kind of review it for yourself. It came from Seeking Alpha. If you have an account there, you can just go read the real deal. And sorry for the way it looks. I got it from Marziti, and he just printed it as a PDF. For a second there, I thought you were sharing a copper chart. Copper was a good play today. SMTC, Simtech Corporation, dropped at power hour. I don't know, your numbers seem a little weird, but I guess they're in your time zone. Um, let's let's bring this up on a different time frame. Oh my goodness. Your time frame was just fine. It looked like it dumped at the open, but I wasn't sure. So yeah, there's the dump. Nice cup. Look at that. Really nice cup. Run it from high of day to low of day, and there's your projections with the 786 and the 111, 1236, and add the half because it's a cup. Cups get halves. Halves way up there. Didn't make it to half. Earnings trades are always sketchy too. Um, what happened with their earnings? Ah, afternoon price targets. That's what happened. Look at that. Morgan Stanley, Oppenheimer, Riley, Roth Capital, they all came piling in this afternoon. Yeah, it's a weird symbol. Let me go back. This is the easiest way for me to point you in that direction because it's a lot of letters, yo. It's a lot of letters. Just copy and paste that. Yeah. ICE Bank of America US High Yield Index Option Adjusted Spread. Now, there's different versions of this, right? If you go in and you start backing it up, let's go to all. Yeah. Yeah, I did. It does look like a password, though, doesn't it? So if you start backing them up, you can see how there's different years and months, and then whether you got the two behind it or you know what I mean. But oh, okay. So now once you have the index, go up here to the plus sign and type in SPX. And I use new price scale when I make mine, but you can do same scale percent or you could put it lower in a new pane. I always use this one, and that way it'll overlap. So if I want to put like the SPX and the IndX on there, new price scale. Now, I don't like my colors to clash, or that's where they're all too close together. So if your colors are all white, or if they're all the same kind, just double click on whatever line you want to change the color of, and then change your color that way. It's the easiest way to get it done. I only look at that chart on a daily. If you could probably go to the weekly and get something out of it if you're swing trading, but I don't know. I don't know. I only use the daily. And hey, sometimes it won't update either. If that happens to you, there's really nothing you can do about it. But don't think, oh man, I broke it. I did something wrong. It's not you. There's just some days it won't get an update. It's like nothing changed, so they didn't move the chart. I hate it when they do that too. Yeah, it is a little wonky. My JP charts are that way, right? These, especially this one on the end. And that's because it's changing the starting point. So when you roll, right? It's changing where it starts from. I only have the SPX on that chart, by the way, because somebody asked me to. When it when it's just my chart by myself, I don't have those on there because this is all I want, anyways, right? But somebody asked if I could overlay the SPX when we were looking at it the other day, and I did it, and it helps to better understand these high points. But you don't need it. It just helps you better understand like what happened to the SPX when this went up. The SPX went down a long ways. It was violent. Now, when you get a reversal like this after earnings, let's see what their bigger picture looks like. Oh, tight range. How many months? We got all that we can get. All right. So 75 seems to be a significant level of resistance for these guys. The last time we got up into that level, it was a real beatdown. But the gap is filled. We've settled this really big bar, finally got outside of it. Got a lot of structure up here to deal with. The outside bar because of earnings. I mean, I understand it doesn't mean I like it, but at least it held 50% of this bar. It got back above. It needs to keep that now. No more dipping below 65. And if we can stay above 65, then we can grind our way through this overhead liquidity and we can try to challenge old school highs back here. There's a market phrase that says if 80, then 100. And I know how silly that sounds, but man, I can't believe how many times that's true. So you'll find a market like this that fights 80 over and over and over and over again. And then they finally get through it. They'll go to 100. But the next trick is getting through 100 and getting above it, holding above it, not just like wicking up there and falling back down again. So the phrase goes if 10, then 20, if 20, then 40, 40 to 80, 80 to 100. And they'll talk about doubles. Like if 20 to 40 is no joke, that's a 100% increase in a stock's price from 20 to 40. And those are real things, like market truisms that have been around for a long time. So we're not through 80 yet, but if we can get a solid close above, I'd like it for 100. It's not. I mean, I think you could find something comparable. I just don't know what it would be, right? Because Thinkorswim has Fed Gov data stuff in here, right? It's really cool, but you have to know what you're looking for. It's got this button right here, economic activity. And so you have all this data. But I don't I don't even know where to begin, right? I know you can't type in that symbol though. There's the 2 year. Oh, hey, we can type in that symbol, but you got to put Fred behind it. Try that. Let me copy it. Hold on. We might be onto something. Symbol, colon, Fred. Bam. How you like that stuff? Huh? That's all you, by the way. I'd have never thought of it on my own. When it didn't work, it didn't work. There you go. Do it just like this, and you'll get it. That's going in the box. Now, I got there from the Fred data, but you can use it on your regular charts. So I'm going to bring it out here and use it on my regular charts. And then if you want the line to be fatter, put on an exponential moving average and set it to 1. Then make that as big as you want it to be. Ta-da! Now we got to figure out what to name it. Just like that. Cool, cool. All right, we just tagged 111 on that newest breakout. So, this kind of fits into the conversation, developing a bias to run the lines. When we got the trend line breakover and it looked like we were trying to run, you can trade the breakover because I mean that's a really beautiful trade. But one of the things that I always try to stress to people is I don't like to trade where we find price right now, right? Like right there on the breakover. For me, I would have been thinking about that breakover while we were still somewhere up here. Not because I knew we were going to get this set up to trade that breakover, because I don't know any more than anybody else. It's because if we did get a trend line breakover, I want to already be planning it and thinking about it, right? So you get the trend line breakover, it fits your play, or maybe you never saw it coming and now it's happening and you're like, shoot, that's a trend line breakover and I didn't even think about it. I didn't even plan for it. Shoot, it's too late. Fine, it's too late. You don't trade that. Instead, start thinking, what happens if we get to the top? Are we going to reverse like we did here and here? Or are we actually going to get a breakout? If we get a breakout, am I going to try to trade that long or trade that short? Right? I'm always planning on where would I like to get a trade rather than, oh gosh, gee, wow, we're getting a trend line breakover. I should try to trade that. No, not now. I should have been planning that trade before it ever got here, right? I'm always trying to look ahead. Where do I want to trade? And I'm as just like anybody else. I will jump onto something that I didn't see coming and I didn't plan for. And I mean, I pay the consequences. Sometimes it works, sometimes it don't. But my best trades come from the ones that I plan ahead before it happens. So that you have time. You can go and look at the dollar and you can look at the tick and anything that you can think of, right? The high low graph, the weighted AD, anything that you can bring in to look at because you have time because it hasn't happened yet. I like those the best because you got plenty of opportunity to try to figure out when we get back to the top, for an example, do I think we're going to break out or breakdown? That gives you a better answer than, well, we got to the line and I guess I need to go long or short now. And if I look and I don't know, right? Like today, I don't know, 50-50 shot that we actually managed to get the breakout or not. If I look at it and I don't know, well, that tells me I don't have a trade, because I'm not able to figure it out in advance. Like, gee, I don't know. Maybe. I don't want to trade maybe. And so I won't do it. So you want to constantly be asking that question, where would I like to get a trade? And then on top of that, how likely is it we're going to get there? Say this level back here. I'd love to get a trade that rejects off of 67.92 cog line. I think that would be a really great trade. How likely is it that we're going to get there? Well, if you'd asked me this morning, I'd have said probably pretty low. But, now we're 10 points away from it. And I don't want to trade in power hour. If we get there today, there's no way I'm trading it. But if you're constantly looking ahead and asking that question, where would I like to get a trade? You can prepare for the opportunity before we get there. Yesterday's 111, so really great trade. And we got one today. Get that out of the way. I missed. That goes up there. There. There's yesterday's 111 right there. We got the breakout. We ran up, rejected 111, come right back in again. And that's a really good trade that I plan for a lot. We had all day from the time that I woke up this morning to finally get up there and get that breakout and get that rejection. I already know somebody's going to say, well, yeah, but what if you wait all day and then it never comes? Well, then I guess I didn't get a trade because, I mean, that's not the only thing we can trade, anyways, right? But you can have more than one strategy and still be trying to answer that question. I want to get a trade at what spot? Looking at where the best trade for you would be, where's it at? Highlight that area. And then how long is it going to take before we get there? Do I have time to walk the dog, get a drink, grab some lunch, whatever, do life things, and then come back and still trade and look at the tick and the AD and whatever I need to look at? Give yourself that time frame and have a better trade because it's where you wanted it to be rather than jumping the gun, getting anxious and getting in and then regretting it. There's another options trade. I think we've talked about this before, but it's called these. If I remember right, they work good on short weeks. This is called a gamma squeeze. Not the ones where you're looking at the sizzle. This is where we're looking at the options tab. Gamma scalpers. There we go. I think that's the scanner that we need. Yeah, 350 minimum. Oh, what do you got? This, for anybody watching the replay, this was shared in the chat. Yeah, that looks like what we've been focused on today. Globex high, the midpoint of yesterday. This is a really good layout, having all your lines like that so you can see at a glance what each particular level is. What's that dotted line up there? Gotta zoom out. Zoom out. Not that much. Goodness. I don't know. Maybe your cursor, huh? Look, that's what it looks like. Your mouse cursor. Yeah, speaking of measured moves, the measured move of Globex was what, 50% or 100% of that, and it dropped right into the mid of yesterday, which is a nice reversal point. I know it's hard after seeing last Thursday to keep in mind, but the S&P and the Nasdaq are mean reverting. So when they make big moves in one direction, your instinct should not be to jump on the train to go in that direction. It should be to look for the reversal of that direction, which is hard to do because last Thursday, man, we just kept going and going and going. And now everybody's, you know, uh, struggling with trying to go the other direction. But these short weeks can break your confidence, they can break your strategy, they can break everything. Uh, they're not they're not good on anybody. TLRY, Tilray. All right, so these gamma scalper trades, they're usually very cheap trades, right? We're talking, pennies, as you can see. The very cheap company, very cheap stocks, crazy cheap options, and they're only really going to load or work well if we move. And 8 out of 10 or 9 out of 10 times, these won't even be a good trade. They're just going to fail. But if you fail 9 times at 1 penny a piece, which is $1, and then you win and you get $25, $30, then it covered all your losses and you're ahead. The problem with the strategy is, well, if you lose 7, 8, 9 times in a row, it's demoralizing, debilitating, insulting. It's hard to chew that kind of loss. Doesn't matter how much dollar value you lost. It's just the mental aspect of losing 10 times in a row is enough to kick anybody. But these gamma scalp trades, the reason that they're so good, or the reason that we want to focus on them as a play, is because of this the Greeks here. Right there, $4.90. If we was to move an entire dollar difference, it would apply 4.90 to this 4-cent option. Talk about a blowout move in the options price. Yeah. Now, just going 50 cents is going to move you a 100-point profit, um, from 4 cents to 40 cents. And that's nuts all by itself, right? It's 1,000% profit. 100% would be making 8 cents. So I don't want to spend all day, every day running gamma squeezes. Believe me, I don't. But I'll tell you, it's more than once that I'll come in and look at what's on the list just to see if it's something that I know, that I recognize, or that might have a reason to make a move, right? You don't need this scanner, by the way. I'm happy to share it. But the idea is you're looking for a high gamma value. And we're talking about a two-tiered gamma structure. The first strike difference is going to load the 490. The second strike move is going to apply the 490. So if this was to go from a $1 stock to a $2 stock in the same day, it would apply that and we'd have a blowout gamma move in that option. But you're talking about a move in a stock of 100% from a $1 stock to a $2 stock. Well, imagine if that was SPY going from 600 to 1200. You know, I mean, that's a huge move. Can it happen? Oh, yeah. Yeah. These little penny stocks can definitely make the move. But is it likely to happen? No, not on most of them. But you get names that you recognize or that fits the right industry or the right sector. Those those really cheap gold mining companies before gold really blew up earlier in the year, or um, some company that does electric vehicle takeoff and landing lidar parts or something. You know, not like the real drone companies, but one of the ancillary companies. You get one of those, catches a news bid and blows the hell up, and it was in your gamma squeeze list, right? You got a reason to be in it. They can play out pretty good. I just brought it up as these short weeks, having something else to do, something else to look at, focus on, investigate, just kind of poking around, seeing what's out there is better than losing your confidence trying to trade the typical systems that we would trade that don't fit these conditions. I think Google's getting ready for a short, by the way. You guys see that crazy runaway coyote move this thing made? So that's the daily. Big gap up. And now we're getting this sort of fake break fast failure setting up. We got 4 minutes. Can we do it? Come on, Thinkorswim. Get your act together. Waiting on you, sweetheart. Yeah, there it goes. Nope, we got to flip it around. It's going the wrong way. Two for you, one for you. Unlock it, turn it into a debit rather than a credit. If you want a credit, run the call side. This would be a debit. It's the most that we could lose is the price that we pay. It has a sweet spot of $300 and a fall down price of $75. The overrun is 170. No, I don't like that at all. Nah, we're not going to hit it in time. If we were just going to throw a butterfly on, we could do that, I guess. But this broken wing fly is not going to get it done. Now we've got some credit to it. So we're talking about Google back below 318 by Friday's close. Risk 100 to make 150 with a sweet spot at basically $400. Risk one to make four. Now we're at 323. We would need a like a $7 move or a $10 move to really see some $8 to see the sweet spot. Still, it's 150 in credit. So once we do break through the break even here at 317, it's all gravy. That's a $6 move to get to that. And we know we're wrong if it doesn't break this last positive day here. I mean, today's positive, but we fell since we opened. We did close the gap, though. Can't argue against that. That's the only reason to maybe not take the short yet is we closed the gap and we ran back up. So if you're looking for a reason to not do it, that's a good reason right there. Besides the market closed, but oh yeah, if you don't use a butterfly of any kind, you're really missing out because it's one of the smallest risk trades that you could ever take. So we're definitely adding that to the list to talk about. When I would do the Benzinga options boot camp, they'd always tell me to bring a trade. And I always brought butterflies because there's just so many versions. We can do so many kinds. And I always brought the butterflies. So yeah, that's definitely on the list. Yeah, there's a lot of little tips and tricks to help people better understand what their real reward is depending on what expiration you use, how far out in time, how long you actually hold it, all of those things, they butterflies can be really disappointing if we have the wrong expectation of what we're going to get. I put one on that was 6 months out and the next day it was in like Adobe or Qualcomm, one of those. It's not really liquid and it's really fat. I put one in that and it made the whole move like the very next day and made it to my target. Well, I didn't make any money because it was supposed to last, like months and it made it there the next day. Well, I was so mad. It made the whole damn move in a single day. I didn't get any money out of it. That sucked. Yeah, we'll dig into those. So you have to treat short-term butterflies completely different than the way you treat the longer-term butterflies. And the shorter ones, they're pretty much you set it and forget it. Like there's no salvaging them. But the longer dated ones, although it feels like you're just rolling dice in the dark, the longer dated ones are adaptable. You can adjust them, tweak them, modify them, and that's what makes them so beautiful. But if if you've only run them in the short term where it's all or nothing, it's hard to grow any confidence to ever try to want to do one in the long term because that's the only way you've ever seen them is like all or nothing. But they're not. They're not all or nothing if they have time to them. And you can just get near the right window and get profitable if they're longer term, which is one of the reasons that makes them so awesome. You don't have to bullseye. Hell, you don't even have to be in the tent to see profit if they're longer term. But if they're short term, shoot, you'll have to play chicken with the close if you open it with 2 days or less of life. Say you open a butterfly on Monday and it's for Wednesday's expiration. You'll have to wait until after 2 or 2:30 in the afternoon on that Wednesday before it even starts to see any profit. So you got like an hour and a half to 2 hours to be in the sweet spot or it loses. That sucks. That's hard to do. But we'll get into it. Everybody, I'll be here for the morning briefing. But that's probably going to be the last one until next week. So I hope everybody has good holidays. Be careful, be safe, and I'll see y'all next week.